Engulfing patterns are two-candle affairs and are similar to the dark cloud and piercing white line formations. The principal difference is that the second candle for a bearish engulfing pattern not only closes more than halfway along the first candle's real body, but below it, thereby totally engulfing it. Here we see a bearish engulfing pattern, which we're assuming develops after a strong rally. The stronger the better, in fact. The first candle consists of a long real white body, followed by a dark real body, whose opening price is higher than the first candle's close, and whose closing price is also below the first candle's open. While the second real body should engulf the first, it's immaterial whether it engulfs the shadows. However, both candles in an engulfing pattern should be relatively shadowless. This is an important difference from the dark cloud piercing line formations, since the real body of the second candle should engulf the extreme shadow of the preceding session. In the case of a dark cloud, the extreme shadow would be the upper one, and in the case of a piercing line, it would be the lower one. Here's a bullish engulfing pattern, which is exactly the opposite of a bearish one. This formation, which should follow a serious decline, consists of a long black real body, followed by a long white real body, which engulfs the first candle's body. It is the second candle which gives us a clue as to the psychology underlying the pattern, because the price opens on or close to the low, as people expect the bearish action of the previous session to continue. Then, as the current candle develops, the bears lose their enthusiasm and prices close up. This one-day reversal of a downside to upside momentum is sufficiently great to result in a change in sentiment and therefore of trend. There are several characteristics which enhance the significance of an engulfing pattern. First, generally speaking, the longer and sharper the trend preceding the pattern, the greater its significance, as shown here. This is a bullish engulfing pattern developing after a sharp price decline. It will have greater validity than one following a much briefer decline, because a pattern which forms after a sharp price move is more subject to profit-taking, in this case by the shorts. The opposite would be true in an uptrend, where an engulfing pattern following a sharp rally is more likely to be followed by a reversal than one after a shallow decline. Returning back to our bullish example, the second point that emphasizes significance is unusually heavy volume on the second engulfing candle, and it's indicative of exhaustion. It's possible, for example, that after a decline, heavy volume on the second candle indicates a small selling climax. Traders come into the day selling heavily as they believe prices will decline. Then, when they don't, the selling is exhausted and sentiment moves in favor of the buyers. Third, the larger the second candle's real body relative to the initial one, the more likely that sentiment and therefore the previous trend has changed. In this diagram, we see two different engulfing tops. The one on the right is the stronger of the two because its real body engulfs both the shadows and the real body of its predecessor. The one on the left is still a valid pattern, but has less strength due to the fact that the real body of the engulfing candle only engulfs the real body of the previous one. In effect, the change in psychology is much more pronounced the more engulfing the engulfing candle can achieve. Taken a step further, if the second candle engulfs more than just the first one of the pattern, an even stronger signal for change in sentiment is given. Here we see two engulfing candles. The one on the left is perfectly acceptable. However, the one on the right is stronger because the second candle not only engulfs the previous session, but several others as well. What makes this more significant is the fact that the engulfed candles really represent an extended period in which buyers and sellers are well matched. The engulfing candle tips the balance decisively in one direction or the other. It's also possible to have an engulfing pattern in which the second candle has an identical opening to the first close. An example of a top is shown on the left and one for a bottom on the right. In a strict technical sense, the second candle does not truly engulf the first, but it's surprising how potent this variation can be. Bearish engulfing patterns develop after an advance. However, if they appear after a decline, they're called a last engulfing bottom. You might think this combination is bearish, but it's actually a bullish pattern. The formation is identical to the bearish engulfing pattern we saw earlier, since it consists of a small white candle being engulfed by a long black one. However, in order to be a positive market force, it must be confirmed by a close above the black candle's close. The same phenomenon can be observed in reverse, where a small black candle is engulfed by a long white one. Confirmation in the form of a close below the previous session's white candle close is also required. This pattern is then known as a last engulfing candle top. Both types of last patterns do not have the kind of outcome one might normally expect, since a long black candle has bearish overtones and a white one is typically a positive sign. Just bear in mind that the last engulfing pattern comes after a trend has been underway for a while. The long white candle indicates a positive attitude among market participants as they override the small preceding black candle. However, the failure of prices to follow through on this newfound bullishness means there's been a change in psychology and the trend reverses to a bearish one.